Welcome back, students who are taking financial accounting, and in this series of videos we are working on the assigned homework problems from the digital study guide for chapter 10, the group B problems. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you do not understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. All right, so next problem. Analyzing stockholders' equity. This is very similar to the previous problem, except it's just presented from a different point of view. Okay. So it says here Davenport had the equity on its balance sheet at December 2014. In dollar amounts, except par value per share, adapted in millions. Okay. 1. Identify the different issues of stock Davenport has outstanding. Well, we have preferred stock, which has 1 million shares issued and outstanding, and we have common stock with 160 million shares issued and outstanding. So that's the answer to that question, preferred and common stock. Give the two entries to record issuance of Davenport stock. Assume all the stock was issued for cash, and explanations are not required. Okay. So for preferred stock, there's $50 million in there, so it would have been a debit to cash because that's what Davenport would have received. So that's for 50 mil. And there would have been a credit to preferred stock for the 50 mil. That's all there is to that, to the issuance of the preferred stock at par value. Right now, for the common stock, we would have a debit to cash, and that debit to cash is not just the 320 million. It also has the additional paid-in capital of 82 million. So 320 mil plus 82 mil is 402 mil. So they would have received 402 million in cash, and there would be a credit to the common stock for the 320 mil, and a credit to the paid in capital in excess of par common for 82 mil. Okay. All right. So pause the video, and because I'm going to erase it. Right, number 3. Right, it says here, assume that preferred dividends are in arrears for 2013 and 2014. Okay. Right. Record the declaration of $31 million cash dividend on December 30th, 2015. Assume no change in the preferred stock account in 2015. Use separate dividend payable accounts for preferred and common stock. Round to the nearest 1 million, and an explanation is not required. Okay, so we have to first figure out, okay, so we're talking about 3 years here. Oops, there's my pen. So we're talking about 2013, 2014, and 2015. And before I get into this, because we're talking about dividends and we're talking about cumulative, I suggest you go back and watch the theory videos if you don't understand it, but in order to get the overall concept. But the reality is that, you know, when I'm looking at this problem is different from any of the other ones. All right, so even if you go back to the theory videos and you go back to the exercises, you're not going to see this exact same problem in those videos. The ideas and the concepts are the same, okay? And that's why I say go back and watch those theory videos, get the concepts down, but apply them to the particular situation, because each situation is going to be different, all right? same principles, different application. I mean, and the more of these you do, the more comfortable you become with the slight variations from the different ways dividends are presented. Okay. All right. So what are we looking at here? We have for a preferred stock, we have 8% is the dividend rate, and it's cumulative, and the par value is $50 per share. Okay. So let's see here. So in order to calculate the dividend owed to preferred stock, right, there's 1 million shares. Okay, so 1 million shares at 8% at $50 per share. Okay. And 1 million times 8% times 50 is $4 million. So in 2013, preferred stock was owed $4 million. Okay, I'm going to erase this. So pause the video if you have to write it down. Basically, it's the number of shares outstanding times the dividend rate of 8% times the par value, $50. And so now this is cumulative stock, right? So that means if it hasn't been paid, right, it says cumulative, if it hasn't been paid, it's still owed in the next year. So when we come to the year 2014, the amount that's going to be owed in 2014 is still going to be 4 million, right? But since it's cumulative, right, this 4 million is still owed from 2013. So at the end of 2014, 8 million is owed to the preferred stockholders. Now, when we come to 2015, an additional 4 million is owed to the preferred stockholders, but because the 8 million was not paid from the previous year, all right, that's still owed to them. So at the end of 2015, the preferred shareholders are owed a total of $12 million over the last 3 years. That's what cumulative is. Okay, for whatever reason, pen isn't writing too well. All right, so during those 3 years, since they weren't paid in 2013, they weren't paid in 2014, and they're owed an amount in 2015, the total amount they're owed is $12 million. So if the dividend is $31 million, okay, it says here, right there, $31 million at the end of 2015, then the first 12 million goes to the preferred shareholders, and the remaining 19 million, so this is preferred stock, and the remaining 19 million is what would go to the common stock, right? To the common stock shareholders, right? So let me erase this a little bit here, and I'll just quickly rewrite it over here. So if we have 31 mil and 12 million goes to preferred, that means 19 million is owed to the common stock shareholders. Now, to make the journal entry, we're going to debit the retained earnings because we're taking it out of retained earnings for the whole 31 million, right? But we're using two separate, it says here we're using two separate dividend accounts. So we're going to credit dividend payable, dividend payable, and notice I'm just abbreviating. I mean, if you're making an actual journal entry, you're going to write out dividend payable preferred. But I'm just taking the shortcut here because I know what I'm doing. If I'm actually working in the workplace, I'm writing things out the correct way. And I would have a credit to the dividend payable common for the 19 million. And that's my journal entry to record that dividend, right? So that's it for this particular problem. If you didn't understand something, rewind, watch the video again, go back and watch the theory videos, and if you're still having trouble with it, feel free to give a call and speak with an instructor.